Good morning or afternoon everyone, and Viska. We are from Group 3 and now we are going to explain our presentation from the collaborative learning materials last week related to revenues. So here is our table of contents. We will explain about the historical cost and mark-to-market system, revenue measurement based on PSAK 72, and analysis on Garuda Case. The first one will be explained by me, Elizabeth, and also Odeta. The second one will be explained by Jannice and Abraham, and the last one will be explained by Yogie and Ainun Nisa. So, I'm Elizabeth. I'm going to explain first about the realization and recognition related to the measurement and disclosure of revenue under historical cost system for financial instruments. So, what is historical cost method? Historical cost method is a measure of value used in accounting in which the value of an asset on the balance sheet is recorded at its original cost when acquired by the company. The historical cost system of accounting is founded on the notion that the historical transaction price is the appropriate basis of measurement in the preparation and presentation of general-purpose financial statements. In historical cost method, the assets and liabilities are shown at their historic cost. So, the increase or decrease value of asset or liability doesn't reflect in the balance sheet. Under the historical cost basis of accounting, assets and liabilities are recorded at their values when first acquired. They are not then generally restated for changes in values. Revenues recorded in the income statement are based on the historical cost of items sold. Certain financial instruments like cash and time deposit may be recorded at historical cost too. Any initial issue premium or discount is amortized to interest over time, and the resulting value is often described as amortized cost. So here's an example related to the historical cost system. For example, a company has 100 shares purchased at a price of $1, and at the balance sheet date, the value rises to $1.3. So, in the historical cost system, no revenue or gain is recognized unless the shares have been sold and there's a difference between the acquisition price and the selling price. But in the mark-to-market or fair value system, it is slightly different with the historical cost system. To find out more about the mark-to-market system, I will pass the presentation to Odeta.
Thank you, Elizabeth. Hello class and Viska. I'm Odeta, and now I'm going to explain about the realization and recognition relating to the measurement and disclosure of revenue under the mark-to-market system for financial instruments. Other than historical method, financial instruments can also be recognized under the mark-to-market method, or also known as fair value method. Mark-to-market system is the accounting practice that involves adjusting the value of an asset to reflect its value as determined by current market conditions. Therefore, if a company uses the fair value method, asset is recorded under its market value instead of its original cost when it's acquired by the company. Assets will be restated, adjusting to the current value applicable at the market. Next, about revenue. According to the definition of revenue adopted by IASB, revenue can result from changes in the value of net assets. Gains or losses arising from remeasurement of assets are included either in operating income or comprehensive income. Now let me explain the application of mark-to-market system using the same example as explained before in the historical method. A company has 100 shares purchased at a price of $1, and at the balance sheet date, the value rises to $1.30. In the mark-to-market system, the increase in fair value of the share is recognized as the gain, whether they're sold or not. A $30 of gain is recognized as an unrealized gain if they are not yet sold, or as a realized gain if they are sold. Okay, that's all from me about the mark-to-market system, and the following topic about revenue measurement based on PSAK 72 will be explained by Jannice and Abraham.
Hello, my name is Abraham, and I will explain about the revenue measurement based on PSAK 72. First, we were talking about determine the transaction price. Before we talking about determination, we must know the definition of transaction price. Transaction price is the amount of compensation expected to be right of the entity in exchange to transfer promised goods or services to customer, not including the amount billed on behalf of third party. So, there are 5 issues of transaction price identification. The first one is variable returns or rewards. The second one is the existence of significant funding component. The third one, estimation of limitation for variables. The fourth one, non-cash return or reward. And the fifth one is the debt return for customer. So these issues may vary when we determine the revenue recognition and the measurement for each issue. Next, how to determine each issue's transaction price. For the variable return, an entity estimates the amount of variable return or rewards by considering the risk of reversal of records, but this have a limit. It is explained in limitation for variable. Entity includes in the price several of all transactions the amount of variable return. Next, for the significant funding component, an entity adjusts the amount of return by considering the time value of money. Next, the non-cash return measured at the fair value if it can be measured reliably or use standalone selling price for goods and services. And the last one, for debt return, is a price reduction. Payment for goods and services can be distinguished or both. For the variable return, we may have advanced determination technique or methods. Next, this is the table to determine the transaction price for the variable return or reward. First one, we must identify is it the reward or return is variable or fixed. If it's variable, we must estimate value of return based on expected value or the most probable amount. Then, we determine the portion, if any, of the return or reward that are most likely to occur with a reversal of income that will not occur in the future. From the portion, we may set the amount as the transaction price. If it from the start is fixed return or reward, we may set the amount as a transaction price. Next, my friend Jannice will explain another material.
Thank you, Abraham. Hello, my name is Jannice, and now I'm going to explain about the allocation of transaction price to performance obligation. The first is allocation based on standalone selling price. Standalone selling price are price of goods or services promised to be sold separately by the entity to the customers. The entity determines a standalone selling price at the beginning of a contract and allocates transaction price in proportion to the standalone selling price. The entity can estimate the standalone selling price if it is not directly observable. When estimating, the entity considers all information, including market conditions, entity-specific factors, and information about the customers that is rationally available to the entity. There are several methods to estimate the standalone selling price, like adjusted market assessment, expected cost plus a margin, and residual approach. The second is allocation of discount. It is when the customer receives a discount for the purchase of a package of goods or services if the total standalone selling price promised in the contract exceeds the benefits promised in the contract. The entity allocates a total discount if all of the following criteria are met. First, the entity regularly sells its good or service in a separate contract. Second, the entity also regularly sells, on a standalone basis, a package of several goods or services that can be distinguished from discounts on the standalone selling price of goods and services in each package. Third, the discount attributable to each package of goods or services described in the second criteria is substantially the same as discount in the contract, and the analysis of the goods or services in each package provide observable evidence of the performance obligations where all discounts in contract covered. And the last is allocation of variable considerations. The variable considerations promised in the contract can be attributed to all contracts or specific parts of the contract, such as one of the following. A. Performance obligations in the contract, or B. Goods or services promised in a distinct series of goods or services that form part of a single performance obligation. After the start of the contract, transaction price may change for various reasons, including the completion of uncertain events or other change in circumstances that change the expected amount of benefits to be an entity strike in exchange for promised goods or services. That's all from me. And the next topic about analysis on Garuda Indonesia case based on PSAK 72 will be presented by my friend Ainun and Yogi. Thank you.
Thank you, Abraham, for your presentation. Hello, my name is Nisa, and I'm going to explain about our analysis regarding the Garuda Indonesia case. First, I will explain what happened in the biggest airline in Indonesia, Garuda Indonesia. On October 31st, 2018, the Garuda Indonesia Group entered into a cooperation agreement with Mahata related to providing in-flight connectivity or Wi-Fi on board and in-flight entertainment services. However, we will discuss about the details later. And then in April 2019, the problem arose as Garuda Indonesia's final statement for the period of 2018 was not signed by two company commissioners, namely on behalf of Khairul Tanjung and Doni Oskaria. They considered the financial statement of 2018 is not in accordance with the Statement of Financial Accounting Standard or PSAK. This, it is a violation of regulation from Otoritas Jasa Keuangan or OJK. And then on June 28, 2019, Garuda Indonesia was ordered to restate their annual report as of December 31st, 2018 and make a public expose no later than 14 days after the sanction letter was stipulated. Garuda Indonesia also subject to administrative sanction in the form of a fine of 100 million rupiah for violation of OJK regulation number 29/POJK 0.04/2016 concerning the annual report of issuers or public companies. Sanctions are also given to all members of the Board of Directors of Garuda Indonesia in the form of administrative sanctions, a fine of 100 million rupiah each for violation of OJK's regulation concerning the responsibilities of the Board of Directors for financial statements. The joint liability of 100 million rupiah is also imposed on the Board of Directors and Board of Commissioners of Garuda Indonesia who signed the annual report because it violates OJK regulation concerning the annual report of issuers or public companies. And next, now let's take a look about the contract. So just like what I have mentioned before, agreement with Mahata related to providing in-flight connectivity or Wi-Fi on board and in-flight entertainment services. The contract is valid for 15 years, and Mahata will cover all costs from provision to maintenance. Mahata will pay compensation fees for the right to install connectivity service equipment on 203 aircrafts and the right to manage entertainment services on 99 aircrafts. The funds are still receivable, but have been recognized as revenue. The income of this corporation with a value of USD $241.9 million or 3.4 trillion rupiah had a big impact on Garuda Indonesia's income statement. Then next, we are going to analyze how we identify this case from the point of view of implementation of PSAK 72, revenue from customer contracts.
Thank you, Ainun Nisa. Hello, my name is Yogi. Now I'm going to analyze how we identify this case from the point of view of implementation of PSAK 72, revenue from customer contract. In essence, PSAK 72 changed the way of recognizing contract revenue that was rigid, rule-based to principle-based. Recognition of contract revenue, for example, how is not based on the amount of down payment received. Based on this new standard, revenue recognition can be done in stage over the life contract, or at a center point, or at a certain point. However, the recognition of incremental income cannot be applied to just any contract. There are conditions related to the consumption of benefits by the customer, an increase of the value in the value of asset on the customer side, as well as an agreement on the contract payment stage. If a contract doesn't meet this condition, the contract revenue can only be recognized when there is an asset surrender at the point of time. So the next is at the PSAK section 2 and paragraph 31 say that an entity recognizes revenue when or as long as the entity fulfills the performance obligation by transferring promised goods or service to customer. Assets are transferred when or during the customer gains control of the asset. Here's some key definition of PSAK 72 based on IFRS 15. First is contract. Contract is an agreement between two or more parties that creates enforceable rights and obligations. The second is income. Income is increase in economic benefit during the counting period in the form of inflow or enhancements of assets or decrease of liabilities that result in increase in equity, other than those relating to contribution from equity participant. The third is revenue. Revenue is income arising in the course of an entity ordinary activities. The fourth is performance obligation, a promise in a contract with a customer to transfer to the customer either a good service that is distinct or a series of distinct goods or services that are substantially the same and that have same pattern of transfer to the customer. Here the 5-step model of new revenue recognition. The first is the contract identification. The second is identify the performance obligation in the contract. The third is determine the transaction price. The fourth is allocate the transaction price, the performance obligation in contract, and the last step is recognize revenue when or as the entity satisfies a performance obligation. So here's the conclusion. Based on PSAK 72 in Garuda case, revenue from PT Mahata Aerotechnology can be recognized to Garuda financial statement if the contract has been approved by the parties to the contract and each party's right in relation to the goods or service to be transferred can be identified. That's all from our group presentation. Thank you.